Well, to tell us more about what's been making headlines in finance and economic news, we're joined now by Suzanne Haddan, who's the Managing Director at BFG Financial Services. Suzanne, thanks for coming in.
Good morning.
We've seen the ratings agency Standard & Poor's maintaining Australia's AAA credit rating. What was behind that?
Well, the good thing is that they not only maintained the AAA credit rating, they actually removed the negative and moved us to stable, which is a great outcome. I'm sure the Treasurer will be very pleased. But there's a couple of elements there. The first is they're basing it us not having a crash in our property prices, just having a slow, comfortable unwind. And the other thing they're going to focus on is we need to get to surplus, and they expect us to get to surplus a little bit later than the government, no surprise there, in the next decade.
You mentioned there the housing prices and that they're not anticipating it to crash per se, but there was a warning suggesting that the government needs to put some money aside for in case that eventuates.
Because what happens is when property prices drop, yes, it's an opportunity, say, for first home buyers, but it causes consumers to lose confidence. It also causes consumers to focus quite rightly on their debt, and that means the economy might slow down from its high rev level of that 3.4 that we saw last month %, and that concerns them that the economy's fiscal position, being the revenue the government receives and then money they have to pay out, will worsen.
Just on debt, before we leave this topic, was there any concern in any of the discourse from S&P about the high levels of debt that we have as consumers compared to our income?
We have a frightening high level of debt. It's about 200% of income per household. And there's a few perfect storm issues. We have our interest rates, as you know, very low from the Reserve Bank, but we've spoken before about out-of-cycle interest rate increases, and now 3 of the 4 major banks have increased their variable home loan rate. The other big issue is, remember those interest-only loans that were all the go in 2014 and 2015? They will be coming off interest only next year and the year after, and that increases people's repayments by about 30%. People have to find that money, and again, we're not getting massive wage increases. In fact, we're just meeting inflation, so they are concerned about that.
It's essentially a knock-on effect, because we saw the poor lending practices that led to some of those interest-only loans that perhaps shouldn't have been issued in the first place, and now we might be seeing the impact of that. What could be the potential consequences of that?
And that is the issue. So people were borrowing too much, and now when they come to renegotiate their loan, say they can't afford principal and interest, and they go and ask the bank, can I stay on interest only? They now assess them under a much stricter criteria, and so they get caught in this storm. And what you don't want to see is people become negative equity owners in their property, meaning they bought it at the high point, they borrowed very high levels, they can't afford to repay it, they sell their property and they get less than they paid. Think about how that'll affect shopping.
Oh, downward spiral, right?
Downward spiral.
In the lead up to Christmas. If we can move on to markets now, we mentioned earlier the Dow Jones has eked out just another all-time high. The trade concerns with the US-China potential trade war didn't seem to eventuate during the week. What are you making of the markets at the moment? Is it a little bit overdone in the States?
Certainly a resilient sentiment, isn't it? Because markets are driven by people's sentiment. And you would have thought with Trump increasing, another 10% on a couple of hundred billion, that they would have had a negative effect. But no, we keep marching on. My tip here is, it's wonderful for your assets, your superannuation when markets are going well, but you need to reflect on what will happen at a point in time when it drops. I don't know when it'll be, but it will happen. And one of the things that concerns me is people not understanding what risk they're taking. You think you're in a balance fund, and it's not balanced. What is balance? Roughly 50% maybe cash, fixed interest, conservative, 50% risk. I was looking at the super fund tables. One balance fund had over 80% in risky assets.
Wow.
So my tip, pull out your super fund statement that you'll be receiving soon, engage and check that you're in the asset allocation that suits you.
And so many people don't know that they can just go and do that with their super funds. Take charge of your financial future, I say.
Oh, so do we, absolutely.
Suzanne Haddan from BFG Financial Services, many thanks for your time today.
Thanks for your time.
Thanks for coming in.